kind of take this as to mean maybe they're looking for more reasons not to cut than to cut. And that's fine, but I think that's kind of where we stay. Afternoon, we have a ton to cover this week between jobs, inflation, GDP, the Fed, income, spending, you name it. So we will kind of jump right into things. I'm Brandon Steele, financial advisor with Mainsail Financial Group here in Bellevue, and our goal is to leave you feeling more empowered after every interaction. And today, we certainly hope to weed out some of the noise of all the craziness, all the data over the last week or so in the markets. And again, we have a ton to cover, so we will actually skip our question of the week this week because there is so much to address. So we'll start off where we kind of kicked off the week, which is Jobs Week. So Jobs Week started here this week. Now, keep in mind, there is still the employment and unemployment rate that comes out tomorrow. So we'll have a little bit more for you next week on that. But we did have job openings come out. Job openings showed at 7.4 million. We had ADP employment report come out that shows that we added 104,000 jobs. This was more than expected, but do keep in mind this ADP employment report has been maybe not the most reliable, might be a good way to put it. So it's always good to pair this up with the number that we'll get tomorrow. But nonetheless, the ADP employment report did show that we added 104,000 jobs for the month as well. Again, we will come back to this next Thursday as we get the final picture, but I will also mention, keep these numbers in mind because when we talk about the Fed here in a minute, this seems to be a very big focus for the Fed here moving forward. We also had Q2 GDP numbers come out, the first advanced estimate here. It shows GDP was up 3%. However, remember that there is a pretty significant impact on exports and imports. So you may remember, if you tune in pretty frequently, last quarter we got the GDP number and it was down quite a bit. We had a negative GDP print. But what I shared was to take that with a bit of a grain of salt because what we saw was a huge impact on how imports translate to GDP. So imports are seen as a negative impact to GDP. Well, the same applies on the opposite side of the spectrum here as well. So as we look to Q2 GDP, again, this number is great, and actually it's better than expected. But again, keep in mind what happened in Q1 was we had a lot of companies bringing in a lot of goods to try and get ahead of some potential tariffs on the horizon. And now in Q2, what we see is that kind of that opposite effect, right? So just keep this in mind. It is important to be aware of the GDP number, but especially these last two numbers, and really, I guess Q3 GDP will need to be read into as well. It is important to drill in, and especially with what's going on with imports and exports and tariff considerations here. And ultimately how some companies decided to fast forward some of their imports to try and get ahead of tariffs, okay? So keep that in mind. But nonetheless, for the headline, the GDP was up 3%. We also had inflation numbers come out this week. So we had PCE and core PCE. Both were up 0.3%. Which was right in line with expectations. Not a whole lot to really talk to here because of the CPI data that we had gotten earlier. It suggested kind of where we would sit here for the PCE numbers. And then we also had personal income and spending. Both of those were up 0.3% as well. So again, inflation, personal income, and spending all up 0.3%. Now, the big thing I want to spend some time on here this week, of course, is the Fed press conference from yesterday. There's a couple bullet points I'll touch on, and then I'll kind of share my takeaway, I guess. One is that the Fed did decide to keep rates unchanged. I don't know that that's that much of a surprise. Some might have expected a rate change, but for the most part, I think most expected we would kind of keep where we stand, and that is exactly what happened. However, the big thing that came up multiple times was really about the labor market. And the Fed said that the labor market remains solid, but I will share it was very confusing here because although they said that there was a strong labor market and no real concerns, in the same breath, they also shared that there is a lot of downside risk to the labor market and what could come. So this seemed to be the theme really, and what Powell shared anyways, as to why they aren't looking at cutting rates quite yet. Overall seems that maybe they're not ready to cut, and this has shifted a little bit because they did highlight the slight tick up in inflation, but it's really interesting because they shared last time the thing to watch was inflation. So we were kind of watching that, deciding how that might translate to rate cuts. However, now inflation's, it did come in a little bit higher than expected, but nothing too crazy. And now the tune has really changed to the labor market. And although, again, the Fed is saying it's really strong, they're in the same breath saying, but watch out. And this is the thing to watch with potential risk to the labor market. So to me, what I kind of get out of all this is that I think in general, the Fed is maybe not ready to cut, and they're looking towards something to point towards why. Uh, now, I'll share kind of my take on that here in a second, but I think that that's kind of where we stand. And I think if anything, what I got out of the press conference yesterday was that there may be a slower path towards rate cuts than I might have expected going into that conversation. And again, because of what the Fed shared last time about inflation, and now what they're sharing about labor markets. So again, I kind of take this as to mean maybe they're looking for more reasons not to cut than to cut, and that's fine. But I think that's kind of where we stand. Now, the reason I say that is that the question comes up, well, should they be cutting? And the Fed's mandate is strong labor market, low inflation, and just a strong, market, essentially economy. So if the labor market is strong, inflation is, I guess higher than what they want, although, again, that wasn't it's not higher than really, it's not seeing growth necessarily at this point, but it could come. But nonetheless, if the labor market is strong, inflation is higher than expected, and markets are all up, generally speaking, why would they cut is the big question. They're really hitting their mandates. Now, of course, the question is, maybe getting ahead of things, but there's no real sign of this need at the moment. So that is the big question here. Again, in general, I actually don't know that they could or should feel the need to cut, if I'm being honest, because again, those, at least from what they're supposed to do, those things are all strong. There's other challenges, of course, of higher rates, but from what they are meant to look at and make decisions around, those things are all strong. That said, I don't know that I really understand what they're actually watching, because again, it has shifted a bit. So I think that's important to be aware of, is that it does seem to me like they are maybe looking for more reasons to keep rates than to cut rates, which is fine. But just maybe the takeaway here is ultimately how this all translates to where rates go through the course of the end of the year. And it might be slower till we see rate cuts than maybe many had thought going into this conversation. Okay, that is a lot. But be sure to tune in next Thursday. Again, we're going to skip our question of the week because we had so much to cover. But next Thursday, we're going to cover the unemployment rate that we'll get tomorrow, plus a lot more earnings roll in. So we'll kind of catch you up a little bit on earnings season as well. In the meantime, have a great upcoming weekend, and we will see you next Thursday at 3.